just happened. Silver Rout as gold eyes, $6,000. It started with silence. Silver didn't slide. It vanished through levels where buyers were supposed to exist. Orders hit the market and nothing answered back. Gold, meanwhile, did something far more unsettling. It refused to follow. While silver collapsed under forced selling, gold held its ground, as if watching something break beneath it. This wasn't volatility. This was pressure escaping a sealed system. When liquidity disappears, when leverage unwinds all at once, markets stop behaving rationally. And when gold begins attracting capital while chaos spreads elsewhere, history suggests something far bigger is forming. The question isn't what just happened. The question is, what breaks next? And who sees it early enough to step aside? Welcome to Boring Currency Ledger. If you're someone who's seen a few market cycles, someone who understands that real risks don't come with sirens, then take a moment and subscribe. Not for excitement, but so this kind of analysis stays on your radar when it matters most. And before we continue, tell us in the comments, from where in the world are you watching right now? Let's begin. The moment did not arrive with warning. There was no single headline, or no dramatic announcement, no official statement that marked the shift. Instead, it unfolded the way serious financial stress often does, quietly at first, then all at once. Silver prices moved sharply lower in a matter of hours, not drifting, not correcting, but collapsing through levels that had previously attracted steady demand. This was not a routine pullback, it was a rout. From the outside, it appeared sudden. From the inside, it was the release of pressure that had been building for weeks. Markets do not break randomly. They break where leverage is dense, confidence is high, and liquidity is assumed rather than guaranteed. Silver had become exactly that kind of market. What made the event notable was not just the speed of silver's decline, but the context in which it occurred. This happened during a period when inflation concerns were still unresolved, global debt levels remained elevated, and geopolitical risks had not disappeared. In theory, precious metals should have benefited from such an environment. Instead, silver collapsed. That contradiction is the first clue that this was not about fundamentals in the traditional sense. The key to understanding the event lies in distinguishing price from structure. Prices move every day, structure changes far less often, but when it does, the effects are severe. This episode was structural. It exposed how dependent certain markets had become on borrowed capital, short-term positioning, and the assumption that exits would always remain open. Silver occupies a unique position in the financial system. It is both a monetary asset and an industrial input. That dual role attracts a wide range of participants: hedge funds seeking momentum, traders using leverage, manufacturers hedging costs, and long-term holders seeking protection. When conditions are calm, this mix creates liquidity. When stress appears, it creates fragility. As selling intensified, bids thinned. Traders expecting orderly markets found that orders were being filled far below expectations. Stop-loss levels triggered more selling, which triggered margin calls, which forced further liquidation. The process fed on itself. This is how routes develop. Not because everyone suddenly changes their mind, but because the mechanics of the market demand immediate action from those who cannot meet rising capital requirements. What made the situation more revealing was what happened next. Gold declined as well, but it did not collapse. It absorbed selling pressure, stabilized, and began to diverge. In financial markets, divergence is rarely accidental. When two related assets react differently to the same stress, it suggests that capital is making distinctions. Gold and silver are often grouped together, but they serve different purposes. Gold is widely held by central banks, sovereign funds, and institutions with long time horizons. It functions as balance sheet insurance. Silver, by contrast, attracts a higher concentration of speculative interest. When liquidity tightens, speculation unwinds first. Insurance is held. This divergence matters because it reframes the entire event. If both metals had collapsed together, the story would be simple: broad liquidation. But when silver breaks, while gold steadies, the signal becomes more nuanced. It suggests that capital is not abandoning safety, it is reallocating toward it. For business leaders and entrepreneurs, this distinction is critical. Financial markets often act as early warning systems for stress that later reaches the real economy. Liquidity events in one sector can foreshadow tighter credit conditions, higher financing costs, and reduced risk appetite across the system. Silver's rout was not just a commodity story. It was a message about leverage, confidence, and the cost of capital. Historically, major financial disruptions share common features. They occur after periods of strong performance. They follow widespread belief that risks are understood and controlled. They are triggered not by bad news, but by an inability to absorb normal stress. This event fits that pattern. The phrase "it just happened" understates the reality. What happened was the visible phase of a process that had been forming beneath the surface. Excess positioning met reduced liquidity. Assumption. To understand why silver collapsed so quickly, one must look beyond price charts and into the structure of the market itself. Markets do not move violently because people panic. They move violently when the system that normally absorbs buying and selling pressure stops functioning. That is exactly what happened. Silver is traded through multiple layers at the same time. There is the physical market, where metal is produced, shipped, and consumed. Then there is the paper market, where futures contracts, options, and leveraged products dominate daily price discovery. On most days, these layers appear connected. During stress, they separate. In the days leading up to the rout, positioning in silver had become crowded. Many traders were not holding silver outright. They were holding exposure through leverage. Leverage magnifies gains, but it also magnifies obligations. When volatility rises, those obligations change fast. The first failure occurred at the margin level. As silver prices began to fall, exchanges raised margin requirements to protect the system. This is standard risk control. But higher margin means traders must post more cash to maintain the same position. Those who cannot do so are forced to exit, regardless of their view on the market. Forced selling is different from voluntary selling. Voluntary sellers choose timing. Forced sellers respond to deadlines. When many participants face the same deadline at the same time, liquidity disappears. Buyers step back. Prices fall until someone with available capital decides the risk is acceptable. This is where silver's structure becomes fragile. Compared to gold, silver is a thinner market. Fewer large institutions provide deep, continuous liquidity. When selling accelerates, there are fewer buffers. Price does not move smoothly from one level to the next. It jumps. As selling intensified, stop-loss orders were triggered. These orders are designed to limit losses, but in fast markets, they add to selling pressure. Each triggered stop became a new sell order entering an already strained system. The market was no longer discovering price. It was searching for liquidity. Another layer of stress came from systematic funds. These funds operate on rules, not judgment. When volatility crosses certain thresholds, exposure is reduced automatically. This de-risking does not consider long-term value or fundamentals. It responds only to signals. As volatility rose, these systems sold into weakness, accelerating the move. At the same time, traditional buyers hesitated. Industrial users do not rush into collapsing markets. Long-term holders wait for stability. Market makers widen spreads or step aside altogether. This creates a vacuum where price can fall rapidly without resistance. The physical market did not disappear during this event. Demand did not suddenly collapse. What disappeared was the willingness of leveraged participants to hold risk under changing conditions. This distinction is essential. The rout was not caused by a lack of belief in silver's long-term role. It was caused by the cost of holding positions in the short term. This is why the move felt disorderly. The system was functioning as designed, but under stress, design reveals trade-offs. Risk controls protect exchanges, not individual traders. Liquidity providers protect their capital, not market continuity. When these priorities align against stability, prices move fast. Gold did not experience the same breakdown because its structure is different. A larger share of gold ownership sits with entities that are not sensitive to daily margin changes. Central banks, long-term funds, and institutions using gold as reserve capital do not liquidate because of short-term volatility. Their presence stabilizes the market. Silver lacks that same anchor. Its investor base contains more participants who must respond to margin calls, volatility targets, and short-term performance metrics. When stress appears, their exits overlap. For business leaders, this matters because similar structural failures occur in other markets. Credit markets, currency markets, and even equity markets can experience the same dynamics when leverage and liquidity are misaligned. The lesson is not about silver alone. It is about how modern markets behave under pressure. Liquidity is often assumed. It is modeled, forecast, and priced. But liquidity is not guaranteed. It depends on confidence, capital availability, and time. When time is removed from the equation, liquidity vanishes. The silver rout was a clear example of this reality. It showed how quickly a market can move when forced selling meets thin participation. It also showed that prices during such events reflect urgency more than value. This does not mean markets are broken. It means they are efficient at transferring risk from those who cannot hold it to those who can. The danger lies in misunderstanding that process. Those who view the event as random volatility miss the warning. Structural stress always appears first where leverage is highest and liquidity is weakest. Silver simply revealed it early. The next question is whether this stress remains contained, or whether it signals broader adjustments across assets that rely on the same fragile assumptions. When silver unraveled, attention naturally focused on the damage. Prices fell quickly, headlines followed, and commentary filled the air. But the most important signal of the day was not found in silver at all. It was found in what gold refused to do. Gold declined, but it did not collapse. It absorbed pressure, slowed, and began to stabilize while stress was still spreading elsewhere. In financial markets, restraint during chaos is rarely accidental. It usually reflects a difference in ownership, purpose, and expectations. Gold is not traded primarily for speed. It is held for durability. Its largest holders are institutions that measure time in years, not minutes. Central banks, sovereign wealth funds, and long-horizon investors treat gold as a reserve asset. They do not respond to margin calls in the same way leveraged traders do. Their presence changes the behavior of the market. This distinction became visible during the silver rout. While forced selling dominated silver, gold's declines met buyers willing to step in, not because prices were attractive in a short-term sense, but because gold still served its core function, preserving purchasing power during uncertainty. In moments of financial stress, markets reveal hierarchy. Capital flows first toward assets perceived as most reliable. Gold has earned that position over centuries. It is not dependent on industrial cycles, quarterly earnings, or credit conditions. Its value is not tied to the performance of a single economy. That independence matters when confidence weakens elsewhere. The divergence between gold and silver also highlights how investors prioritize risk. Silver carries both monetary and industrial characteristics. When growth expectations wobble, silver can be pressured from two directions at once. Gold faces only one question: does it still protect capital? During this event, the answer appeared to be yes. This is why the discussion around gold moving towards $6,000 has gained attention. It is not a prediction of immediate price action. It is a reflection of how capital behaves when it senses instability in the system. Large numbers act as psychological markers, but the real driver is allocation, not targets. Historically, gold has often lagged during speculative surges and led during corrections. It does not usually produce excitement early in a cycle. It produces reassurance later. When leveraged positions unwind, gold becomes a place where capital can pause. This pattern has repeated across decades. During periods of credit stress, currency uncertainty, or geopolitical risk, gold's role becomes clearer. It is not purchased for yield. It is purchased for certainty in an environment where certainty is scarce. For decision makers, this behavior matters more than daily price changes. Gold's stability during silver's rout suggests that capital is becoming more selective. It is moving away from trades that depend on liquidity remaining abundant and toward assets that can endure tightening conditions. This shift has broader implications. When gold begins to attract capital while other assets struggle, it often coincides with changes in financial conditions. Credit becomes more expensive. Risk tolerance declines. Investors demand higher quality and stronger balance sheets. Gold's behavior also serves as a reference point for currencies. When trust in fiat systems weakens, gold often absorbs that concern quietly. It does not spike immediately, it builds a base. This is how longer-term trends begin. The key takeaway is not that gold is immune to volatility. It is not. But its reaction function differs. It bends before it breaks. That difference is critical when evaluating systemic risk. For businesses and entrepreneurs, gold's divergence offers a lesson in resilience. Assets and strategies that rely on constant liquidity are vulnerable during stress. Those designed to withstand uncertainty perform differently. The silver rout was a stress test. Gold's response was the result. It revealed which assets are treated as risk and which are treated as refuge when systems are under pressure. As markets move forward, the question is not whether gold will rise tomorrow. The question is whether this divergence marks the early stage of a broader reallocation of capital towards safety and durability. If history is a guide, such shifts do not reverse quickly. They develop quietly, then become obvious only in hindsight. The silver rout drew attention. Gold's stability delivered the message. The final piece of the puzzle lies outside metals altogether. It rests with the currency system that connects all markets. And that is where the next signal must be examined. Every major market event eventually leads back to one question: where does capital feel safest? The answer is rarely found in commodities alone. It is found in currencies. During the silver rout and gold's divergence, the US dollar operated quietly in the background, shaping outcomes without drawing attention to itself. The dollar is not just a currency. It is the base layer of the global financial system. Most trade, debt, and financial contracts are settled through it. When stress enters the system, demand for dollars often rises. not because confidence is high, but because obligations must be met. This dynamic becomes especially powerful during liquidation events. When leveraged positions unwind, participants do not sell assets to hold cash by choice. They sell because they need dollars to satisfy margin requirements, repay short-term funding, or reduce exposure. In those moments, dollars are not an investment. They are a necessity. This explains why traditional correlations often break during stress. Gold can fall while the dollar rises. Risk assets can fall together. These moves confuse observers who expect neat relationships. But forced selling does not follow theory. It follows mechanics. During the silver rout, the dollar did not surge dramatically, but it remained firm. That firmness matters. A stable or strengthening dollar increases the pressure on dollar-priced assets. It raises the real cost of holding positions and tightens global financial conditions, especially for countries and companies that rely on dollar funding. For businesses operating across borders, this has direct consequences. A firmer dollar raises import costs, stresses foreign earnings, and complicates debt servicing. Companies with dollar liabilities but local currency revenues feel the strain first. This is how currency dynamics move from financial markets into operating realities. The dollar also plays a psychological role. When markets sense instability, participants seek instruments that can settle obligations universally. The dollar's dominance ensures demand even when confidence in other assets wavers. This demand can persist, even as concerns about long-term purchasing power remain unresolved. This creates a paradox. The dollar can strengthen in the short term while being questioned in the long term. That tension is critical. It forces markets to oscillate between liquidity preference and value preservation. Gold's role emerges from this conflict. It does not compete with the dollar in function, but it complements it in trust. During periods of dollar firmness, assets that depend on easy financing suffer most. Silver, with its leveraged participation, fits that profile. Gold, held without leverage by long-term entities, responds differently. The divergence seen earlier is partly a currency story. For entrepreneurs and capital allocators, the lesson is clear. Currency conditions influence more than exchange rates. They affect financing, risk appetite, and strategic flexibility. Ignoring the dollar during periods of stress leads to incomplete analysis. Historically, major financial transitions involve currency pressure before visible economic slowdown. The dollar's behavior often foreshadows tightening credit conditions. Banks become cautious. Lending standards rise. Capital becomes selective. These shifts do not announce themselves. They are felt gradually. The silver rout occurred in such an environment. Not because the dollar was extraordinarily strong, but because it was strong enough to expose weaknesses elsewhere. Markets do not need extreme moves to break. They need just enough pressure to test assumptions. This is why watching the dollar as a trend, not as a daily move, matters. A range-bound dollar allows markets to stabilize after liquidation. A trending dollar extends stress. The direction, not the level, shapes outcomes. For business leaders, planning investments, expansions, or financing, this distinction is vital. Decisions made under the assumption of abundant liquidity can become liabilities when currency dynamics shift. Resilience requires understanding where funding comes from and how sensitive it is to currency stress. The dollar is often blamed for market volatility, but it is more accurate to say it reveals it. It exposes where leverage is concentrated and where dependence on external funding is highest. As markets move forward from the silver rout, the dollar's behavior will determine whether stress dissipates or spreads. It will influence whether gold's stability becomes a base for growth or a warning sign of deeper caution. In the next stage, the impact of these financial signals moves beyond markets and into the real economy. That is where businesses feel the consequences most directly, and where strategy matters more than speculation. Business impact when financial stress reaches the real economy. Market disruptions rarely remain confined to trading screens. They migrate outward, first into financing conditions, then into corporate decision-making, and finally into everyday economic activity. The silver rout and the signals surrounding it are no exception. For businesses, the relevance lies not in the metal itself, but in what the event reveals about the state of capital. When markets experience forced liquidation, risk tolerance changes. Lenders reassess exposure. Investors demand higher compensation for uncertainty. Projects that appeared viable under loose financial conditions face new scrutiny. This transition does not happen overnight, but it begins quietly, often immediately after a volatility shock. The first channel of impact is credit. Financial institutions respond to instability by tightening standards. Loan approvals slow. Covenants become stricter. Short-term financing becomes more expensive. For small and mid-sized enterprises, this can feel sudden. Access to capital that once seemed routine begins to require more documentation, higher collateral, or higher cost. The second channel is input pricing. Silver is an industrial material used in electronics, energy systems, and manufacturing. While the rout was driven by financial mechanics, price instability affects procurement planning. Volatile input prices complicate budgeting, contract negotiation, and inventory management. Businesses must decide whether to lock in costs or wait for stability, both of which carry risk. The third channel is confidence. Markets influence expectations. When entrepreneurs observe sharp asset declines, they become more cautious. Hiring decisions are delayed. Expansion plans are reconsidered. Capital expenditures are staged rather than committed. These responses are rational. They reflect uncertainty, not pessimism. History shows that economic slowdowns are often preceded by financial tightening rather than declining demand. Businesses react to the cost and availability of capital before customers change behavior. This is why early signals from markets matter. The silver rout also highlights the danger of over-reliance on short-term financing. Companies that fund operations or growth through rolling credit lines are vulnerable when liquidity conditions shift. What was affordable becomes expensive. What was available becomes conditional. By contrast, businesses with strong balance sheets and conservative capital structures gain flexibility during such periods. They can negotiate better terms, acquire distressed assets, or invest when competitors pull back. Financial stress redistributes opportunity as well as risk. Another implication lies in investor behavior. After liquidation events, capital becomes selective. Investors favor clarity, cash flow stability, and resilience over growth narratives. Business models dependent on continuous funding face pressure. Those demonstrating durability attract attention. For young entrepreneurs, this shift is often misunderstood. Volatility is seen as a market issue rather than a business issue. In reality, financial conditions shape entrepreneurial ecosystems. Startups find fundraising harder. Valuations compress. Exit timelines extend. These effects stem from changes in risk appetite triggered by events like the silver rout. Large corporations are not immune. Currency fluctuations affect international revenues. Hedging costs rise. Strategic forecasts become less reliable. Management teams must adjust assumptions quickly to avoid misallocation of resources. The silver event also serves as a reminder that markets often move ahead of economic data. By the time official indicators reflect slowdown, financial conditions have already changed. Those waiting for confirmation react late. This is why strategic planning must incorporate market signals, not to trade them, but to interpret them. Volatility in one asset class often precedes adjustments elsewhere. The message is rarely literal, it is directional. Business leaders who treat such events as irrelevant noise miss an opportunity to prepare. Preparation does not mean retreat. It means reassessing exposure, strengthening liquidity buffers, and stress testing assumptions. The most common mistake during these periods is overconfidence. Past success breeds the belief that systems will continue to function as before. Financial stress events challenge. Every major market disruption eventually leads to a defining question. Was the event a temporary reset within an existing system, or was it the beginning of a deeper repricing that changes how risk is valued? The silver rout and the signals surrounding it place markets at exactly that crossroads. A reset is the more familiar outcome. In this scenario, excess leverage is flushed out, volatility declines, and liquidity gradually returns. Prices stabilize, not because enthusiasm comes back, but because forced selling ends. Markets regain balance once participants who could not hold risk have exited. This process can be uncomfortable, but it is not destructive. A reset requires specific conditions. Price behavior must slow. Daily ranges shrink. Selling pressure fades rather than accelerates. Most importantly, confidence in market structure must be restored. Participants must believe that liquidity will be available when needed. Without that belief, risk-taking does not resume. If this path unfolds, silver may eventually recover as speculative pressure eases and longer-term participants re-enter. Gold would likely continue to hold its role as a stabilizing asset, providing a reference point rather than leading explosive moves. Business conditions would normalize, though with more caution than before. The alternative is structural repricing. This occurs when stress reveals not just excess leverage, but flawed assumptions about liquidity, funding, or risk. In this scenario, markets do not simply bounce, they adjust expectations. Asset valuations compress, capital becomes more selective, volatility remains elevated. Structural repricing is driven by persistence. If selling continues despite rebounds, if liquidity remains thin, and if correlations shift for extended periods, markets are signaling a deeper transition. In such cases, confidence takes longer to rebuild, because participants must adapt to a new environment rather than return to an old one. Gold's behavior will be critical in distinguishing between these paths. If gold continues to attract capital while other assets struggle, it suggests ongoing demand for safety. If gold begins to weaken alongside risk assets, it may indicate broader deleveraging across the system. The dollar will also provide clues. A stable or range-bound dollar supports reset scenarios by allowing global liquidity to recover. A strengthening dollar extends pressure and supports repricing. Currency trends often decide whether financial stress dissipates or spreads. For business leaders, the distinction matters less in theory than in preparation. Both scenarios reward discipline. Both punish complacency. The difference lies in timing and magnitude. In a reset, opportunity returns relatively quickly. Businesses with patience and liquidity can resume growth plans. In a repricing, opportunity emerges later, often through consolidation, acquisition, or strategic repositioning. The mistake is assuming clarity will arrive before action is required. Markets rarely provide certainty in advance. They provide signals. Those signals must be interpreted and acted upon cautiously. One such signal is the behavior of closes rather than intraday moves. Markets that are stabilizing tend to close stronger over time. Markets undergoing repricing often close weak despite occasional rebounds. This pattern reflects conviction, not emotion. Another signal is the response to news. In reset environments, bad news loses its power quickly. In repricing environments, even neutral information triggers selling. This asymmetry reveals sentiment. The silver rout forced these questions into focus. It exposed fragility in leveraged markets and highlighted differences in asset resilience. It reminded participants that liquidity is conditional, not permanent. For entrepreneurs and decision makers, the appropriate response is not prediction. It is preparation. Maintain liquidity, reduce dependence on short-term funding, prioritize flexibility over expansion driven by assumptions of easy capital. Markets reward those who respect uncertainty. They punish those who assume stability. Whether this moment becomes a footnote or a turning point will be decided by behavior in the weeks ahead. What is certain is this: the event was not isolated, it was a test. And tests, once administered, often lead to change, whether markets are ready for it or not. Those who recognize the signal early gain time. Those who dismiss it rely on luck. In periods of transition, time is the most valuable asset of all.